Welcome to Jeff's World, the weekly 30-minute show where our goal is to help you make more informed investment decisions. And we'll cover key opportunities and risks for investors tied to developments around the world. And here's the best part, we take your live questions from the chat on YouTube. So you can ask us what's on your mind at any time by entering it into the chat. And we'll get to those questions in just a few minutes after we share some of our latest insights. Now, this is our last show of 2024 as we take a break for the holidays, so we've got a lot to cover before we see you again in the new year. Now, we've got a few required disclosures before we get started. Of course, we don't know you personally, so we don't make personalized recommendations, but we do talk generally about the markets, sectors, and areas of investing we think are likely to perform well or poorly, and why, though we don't provide an outlook for specific stocks. And things can and do change, so all our thoughts are subject to change as well. And of course, investing has risks, and international investing has unique risks like currency moves. So please keep all that in mind as we go through our talk today. Now, as is the case every week, I'm joined by Michelle Gibley and Heather O'Leary on the global strategy team here at Charles Schwab. Good morning, ladies, and happy holidays.
Good morning, Jeff. Good morning, everybody.
Good morning, everybody. As usual, I will be watching the chat, so please be sure to submit your questions, and we will get to those as soon as we can.
Yeah, oh, and by the way, hey, be sure to check out on my X and LinkedIn feed. I've got a little "Twas the Night Before Christmas" market outlook 90-second video that I just posted this morning. You might enjoy that. But I won't cover that right now. I'm going to talk about not our 2025 outlook because we did that last week. That's on schwab.com if you want to check it out. This week, I want to start with the top 5 surprises for 2025. You know, history shows us that the biggest surprises in a typical year aren't usually from out of left field, although that sometimes happens, as it did in 2020 with the pandemic. Rather, they're often hiding in plain sight. As goes one of my favorite quotes, often attributed to Mark Twain, "It ain't what you don't know that gets you in trouble. It's what you know for sure that just ain't so." Surprises most often appear when there's a high degree of confidence among market participants in a specific outcome that just doesn't pan out, for better or worse. So by identifying the unexpected, here are our top global upside and downside surprises to our base case outlook for next year in no particular order. So I'm going to go through all 5 of these, and Michelle and I are going to cover them. Number 1, tariffs come quickly and go quickly. Shifts from rate cuts to rate hikes as the markets begin to ponder what's coming from central banks. Sentiment in Europe rebounds, that'd be a surprise. Supply chains could be disrupted, again, not good news if it happens. And that China recovers also will be a surprise to many investors. So let me start with the first one, and then Michelle, I'll kick it to you to talk about what comes next after this. But tariffs could come and quickly go. Since the election, currency markets, the big move up in the dollar, seemingly is pricing in a moderate rise in U.S. import tariffs for major trading partners. But volatility could ensue if markets are surprised by the imposing tariffs being much higher and then abruptly being dropped or sharply reduced. And there's some reason to believe that that could occur next year. You know, during his first presidential term, President-elect Trump threatened imposing large across-the-board tariffs on China and ending a trade agreement with Mexico and Canada. But Trump not only forged a phase 1 trade deal with China, but also successfully renegotiated the USMCA agreement. He also renegotiated existing free trade agreements with South Korea and Japan. So if history is any indication, the extreme tariff threats may simply be negotiation tools leading towards agreements with China and other countries, making the prospect of potentially much less disruptive to economic growth and inflation and sales and operations of multinational corporations. And the agreements could come quickly on the heels of new tariffs. This has already happened this year, although not in the US. It happened in Europe. On October 29th in Europe, an eye-popping 45% tariff was imposed on some Chinese-made electric vehicles. And that was rapidly followed by rounds of talks between European and Chinese trade representatives. And there's not yet a final agreement yet, but the negotiations have led to a technical consensus which scraps the tariffs in exchange for a minimum selling price on imported EVs, according to comments by the chairman of the European Parliament's Trade Committee and some of the comments from the Chinese side as well. So it looks like 45% tariff put in place. 2 days later, they started negotiating, and maybe a month or two later, they're gone. So that would be really interesting and kind of maybe a precursor of what could come next year. And an even more recent example is the late November announcement of 25% tariffs on Mexico and Canada, and additional 10% tariff on China to be implemented on Trump's first day in office, unless those nations take some steps to address drug trafficking and illegal border crossings. But it's just like what Trump threatened back in May of 2019, specifically on Mexico, when he announced a 25% tariff on Mexico, 5% imposed on June 10th, and then 5% increases every month till it got to 25%, unless Mexico stopped the flow of illegal immigration to the U.S. But that threat was never imposed. It was dropped by President Trump like a couple of weeks later after Mexico agreed to pursue an enforcement surge to curb irregular migration, mainly on their southern border coming up from Guatemala. So, again, we could see that turn around. And in response to last week's announcement, or I guess it was 2 weeks ago now from the Trump administration, Canadian President Trudeau met with President-elect Trump, and Mexican President Sheinbaum sent a letter. They both said, look, we want to cooperate on these issues of drug trafficking and illegal border crossings, so they may avert those tariffs entirely. Or maybe they go into effect and then they get yanked really quickly. So be interesting to see. I still think tariffs rise a bit. That's our view in our base case 2025 outlook. But it seems that the extreme tariff announcements may be used by Trump as a tool of statecraft to extract actions or concessions rather than tools of economic policy. And it's worth noting that Trump doesn't have a mandate on implementing tariffs based on polling data of voters' intentions. Polling data shows voters expect Trump to focus on inflation. 35% of them saying inflation should be the first thing he deals with in his first 100 days in office, which tariffs might bring if they're implemented at the level they were proposed, and not on implementing tariffs. If you look, only 1% of the respondents said that he should be focused on tariffs in his first 100 days. So definitely not a tariff mandate there, more of an inflation mandate. So the uncertainty over tariffs being announced and then potentially dropped or reduced following negotiations could create some market volatility next year, rather than just assuming a certain level of tariffs is static from when it's imposed. All right. Michelle, why don't you talk about maybe our second big surprise next year that could potentially come as a shock to our outlook, China rebounding.
Yeah, we saw, a little bit of this year, but we could get some strong performance by China's stock market next year. And that would probably surprise investors given, what's expected to be a weakening GDP outlook and President Trump's America First policies. Since the election day, markets have seen leadership by U.S. small caps, and while international stocks and especially emerging market stocks have lagged badly. And that's exactly what happened after Trump won in 2016. But what was surprising to many people is that it completely reversed the next year. In 2017, Trump's first year of his term. Now, despite the risk of tariffs and the uncertainty of a Trump administration, emerging market stocks rose nearly 40% in 2017, and that was led by a 56% gain in China. That was followed by the outperformance of international stocks, and then U.S. stocks were the worst performers. In 2017, China implemented a fiscal package of around 10 trillion yuan or 1.4 trillion US dollars that was primarily focused on addressing local government debt issues and boosting a slowing domestic economy through infrastructure spending and other measures. And this package was really significant because it represented a whopping 12% of 2016 GDP. This year, in 2024, China's government announced a flurry of measures in September to boost economic growth. But heading into this week, the MSCI China Index lost half of the gains made in the gains after that, as hopes about fiscal stimulus faded. Last night, we got a readout from the 24-person leadership of the Politburo. Now, it kind of repeated this change in tone that started with those announcements in September. Among the headlines were moderately loose monetary policy. That was a phrase that they last used in the global financial crisis. More proactive fiscal policy, extraordinary measures. Those raised expectations of a wider fiscal deficit. And they also gave some vows to implement economic reforms and vigorously promote consumption. Now, this announcement came after the mainland markets closed, but before the Hang Seng Index in Hong Kong closed. So you might see some differences in performance there. Now, the Politburo sets the agenda for the broader Central Economic Work Conference in the days following. Last week, Bloomberg indicated this could occur December 11th through 12th, so later this week. And that meeting creates the economic priorities for the next year. Now, details of any stimulus or reforms are going to be really important. They may not give us those until the March National People's Congress, because that's the way it usually works. And this would give the government some time to assess the potential tariffs under a Trump administration and how they want to respond. Now, while a fiscal package in size equal to 2017 is unlikely, stocks could rise on a much smaller package if it includes some concrete measures to boost consumption and halt the property market downturn. And we already saw last night the Hong Kong Hang Seng rose 2.7%, and it could be, more to come, or we could see some, downside surprise if they don't follow through.
Yeah, Michelle, it's still a lot of promises. Promises are good, and the more promises, the better, I guess. But we'll see if they deliver this time. But yeah, that's why it's a surprise, right? It's sort of not our base case. We see more of a muddling through, maybe slower recovery for China. We've talked about this sort of long, shallow U-shaped turnaround, but certainly, the potential for a big boom in stimulus would definitely change the calculus there. It could be good news for economies like Europe, which is very tied to Chinese consumer demand. So anyway, yeah, that'll be an interesting surprise for next year, one we'll keep a close eye on and keep all our viewers informed about. A third potential surprise is that the market shifts from pricing in rate cuts next year to rate hikes. The market is really confident in rate cuts by major central banks throughout the first half of 2025. As inflation rose across most major countries in the fourth quarter of this year, we saw that most major countries saw a tick up in inflation. Markets have now reduced the number of additional rate cuts they're expecting over the next couple of years. And it's possible, look at this chart here. So this is like the number of rate cuts. All these numbers are negative here, right? So if you look at this chart, on the left scale, it's like how many cuts, how many basis points worth of cuts. And you see this rise in the fourth quarter from the beginning of September to where we are now. It's really climbed, in part because some cuts have been made. But the point is that the market's sort of like looking at fewer and fewer and fewer cuts as it's looking out over the next 2 years. It's possible that by the middle of 2025, the market might anticipate a rise in policy interest rates over the coming 2 years and not further cuts, which would be a big shift from the major cuts priced in during 2024. It's worth noting that Brazil's central bank has shifted to hiking rates in recent months. Why do we care about Brazil? Well, over the past few years, Brazil's been leading other central banks, initially as the first to hike rates in 2021, about a year ahead of the Fed, and many other central banks as well. And then they were the first to cut in 2023, also about a year ahead of the Fed and some other central banks. Now, recently, they've started to hike once again. Inflation in Brazil bottomed in the middle of last year at 3.2%, but it's since then climbed up to about 4.8%. So they're kind of leading the trend in global inflation. Brazil might be signaling what could come if inflation creeps higher. Hiking cycles could get cut short, cutting cycles could get cut short. The potential for a shift from forecasting rate cuts or even the expectation for rate hikes on the horizon as 2026 comes into view in developed markets economies could result in stocks selling off if markets really get concerned about these potential for a shift to worrying about rate hikes instead of just focusing on the positive stimulus from rate cuts. All right, that was number 3. Michelle, you mentioned confidence returning in China as a surprise, but what about things turning about in Europe as another surprise for the year?
Yeah, I think that we hear a lot of negative news about Europe, but there's a potential where they could have a better outlook next year. Economic growth has been below average the last 2 years. It's been led by softness in its largest economy, Germany. Germany may post the second straight year of contraction in 2024 amid weaker global demand for manufacturing goods, especially automobiles tied to higher interest rates, as well as the slowdown in demand from China, which is Europe's largest export destination. So sentiment has been weak, but it could be poised to shift. On an absolute basis, sentiment remains below average, but if you look at the November IFO Business Climate Survey for Germany, it shows that expectations for the future relative to the current situation are at the highest level since the rebounds from both the pandemic in 2020 and the Eurozone debt crisis in 2011. Both instances preceded a strong rebound in overall sentiment, economic growth, and stock performance. Now, as I mentioned, recent headlines may seem worrisome with France's government collapsing over a budget impasse and Germany's minority government unable to pass a budget, but they could lead to fewer budget cuts for next year and less of a drag on Eurozone growth. Additionally, we could get a decline in energy costs. The poll-leading CDU party is moving away from its opposition to nuclear energy, which could provide a longer-term benefit to the German economy in terms of lower costs. In the near term, Europe's access to low-cost energy could increase as LNG import capacity is set to outpace demand growth next year. That's according to the U.S. Department of Energy. And the Trump administration could lift the pause on LNG export permits that was put in place during the Biden administration as a way to rebalance trade between Europe and the U.S. That could further boost natural gas supply to Europe, which again could reduce energy costs. Additionally, Eurozone stocks, their valuations are depressed, trading at just 13 times next 12 months expected earnings. It's a 40% discount to the S&P 500, a much bigger discount than historically average. And a rebound in sentiment could boost valuations, with each 1 point of valuation increase estimated to boost returns by 7%.
Yeah, to be clear, we do see Europe growing faster next year, and maybe valuations rising a little bit. But I think investors would be surprised generally by the potential of a sharper turnaround, as you said, on lower energy costs, on less of a fiscal drag, than has currently been baked in. And then the potential tied to our other surprise, your second surprise that you talked about, which was China rebounding. All that could really play into much more momentum for Europe next year. We see a recovery there, but a modest one with still below average growth. But there's a potential for average growth, maybe even above average growth if things really turn around. That would be a positive surprise for 2025. Now, finally, as a fifth potential surprise, number 5 for 2025, supply chains could be disrupted. I know we don't want to see this again, but the supply shortages that we experienced during the pandemic were a lesson in the interconnectedness of the global economy and how disruptions in one part of the supply chain can ripple through to other areas. Supply chain disruptions no longer dominate the headlines today, but they've crept up from time to time. In the past couple of years, shipments in the Panama Canal were slashed due to a drought that reduced the necessary water to move ships through the locks. We talked about a lot here on the show. Droughts in Europe disrupted German Rhine River trade. In fact, they couldn't get coal to energy, to electricity plants because they couldn't move it along the river. So there was all kinds of spillover effects there for a period. Houthi rebel attacks in the Red Sea have diverted trade around the Suez Canal. So that's really diverted ships to take a much longer 2 or 3 week longer route, a much more expensive route around Africa. Not to mention the collapse of the Key Bridge in Baltimore Port, causing shipments to be redirected there. That's a big auto hub for the U.S. Other weather impacts have included excessive rain, freezing cold, fires we've seen. None of these caused rebounding inflation or materially impacted production, but a more significant supply disruption would be an unwelcome surprise. And the thing about supply chain disruptions is they're really unpredictable. They kind of come from unpredictable events. So it's hard to say, oh, we could get one here, we could get one there. But I'll give you some signs of vulnerability. There are policy risks to supply chains. The deportation of Mexican-born population from the U.S. could disrupt supply chains in some industries, right? It could create labor shortages in some industries, agriculture being one. Global increases in tariffs could result in further diversions in trade flows. So we have to see what the policy risks are to supply chain issues. There are weather risks. I mentioned those, but Hurricane Helene flooded Spruce Pine, North Carolina. You may not think a lot about Spruce Pine, North Carolina. I think about it a lot because it is the global hub. Almost the entire global supply of high purity quartz, the kind needed to make the crucibles that hold the molten silicon as it's formed into a silicon wafer, comes from there. Try and make semiconductor chips without that high purity quartz in order to make the machines that do that. You can't do it. Really hard to do. There are a few other, there are so many different tech companies around the world looking for other sources. They really haven't found any kind of quantity. Now, luckily, those mines were brought back online. They were flooded back in September of 2024 with Hurricane Helene. Only 4 weeks later, they were brought back online. Literally, the mines were flooded, but so much attention on getting that back online. It was. We dodged a potentially severe disruption of the global supply chain for semiconductors. Imagine what that would have done to a stock market that was led by semiconductors. So there's those weather risks, right? That's just an example of a vulnerability we don't often think about that crops up from this. There's geopolitical risks, right? The conflicts surrounding Ukraine and Israel continue to exact an immeasurable human toll. The market and economic impacts have been limited. Oil prices are wrapping up the year. Let me just pull it up real quick here. So WTI, West Texas Intermediate, $68.67 right now. That's pretty close to the low end. I'd say 65 or so is the low end of that range for the year. Now, ceasefire agreements may take place in 2025, but the conflicts could also linger or even expand. And should oil facilities in Russia or Iran be targeted, oil prices may surge on supply shocks and act as a drag on growth and a boost to inflation. So supply of oil could be an issue. And then you've got technology-related outages. I won't go on and on, but the cyber attack on the Colonial Pipeline in the U.S. in 2021 and the IT outages, such as the CrowdStrike faulty system update in July of this past year, could derail the flow of energy or information. So all that is a vulnerability. And we've got global trade volumes having recently climbed to new all-time highs. After 2 years of stagnation, you can see it in this chart here. This is global trade volume. So we're taking price out of this so that you don't get the inflation surge. You can actually see the volume, the number of units of goods shipped around the world. This is indexed. But you can see we just recently in September, October, and August, I think it was, hit a new all-time high in terms of the amount of stuff being shipped around the world. So we're vulnerable to a risk of disruption, and where and when these disruptions occur are all naturally unpredictable and could seem to come out of nowhere to surprise markets and reduce growth and boost inflation. So, okay, let me wrap this up. The key message is to be prepared. While we highlighted our top 5, there are a lot of other potential surprises that could happen next year, including those that are ever-present parts of investing and not unique to the outlook for any particular year, like rising fiscal sustainability concerns as debt and deficits continue to spiral ever higher. Another pandemic could emerge. We're talking about disease X in Africa right now. Could that spiral out of control? Who knows? The outbreak of wars, obviously, among many others. So whether or not any of these particular surprises come to pass, the new year almost always brings surprises of one form or another. And that's why having a well-balanced, diversified portfolio is really important in the event of an unexpected outcome. So let me stop there and Heather, turn to you and just see what questions have come in.
Well, we can only have one question so far. We have one of our traders wondering about the Singapore exchange and if we have any news or ideas specific to the Malaysian markets, given what might be going on with a rebound in Chinese confidence.
Clearly, I'll start it off, and then Michelle, I'll turn it to you. China drives so much of the economy in Asia. It's just absolutely massive in terms of its import and its influence in financing. That it's huge. So certainly the potential for a sharper rebound in China. And yes, you see some of that in the Hang Seng today. Stocks are popping, Singapore. Other markets in the region are upbeat on the idea that China is going to actually deliver on their promises. They've not so far. I mean, it's been years, but maybe they will. Hopefully they will. They seem to be getting the importance of it. And that could certainly turn around the region and lead to better growth across that whole area. Michelle, do you want to add to that?
Yeah, I would say for both Singapore and Malaysia, those indexes are really they're 40% financials. And so it's not very diversified. It's concentrated in a few names. In terms of their economies, Malaysia is really a hotbed for chip testing, assembly, manufacturing, packaging. So they're really, in that supply chain. They don't have a lot of room to expand in terms of capacity relative, like, let's say, Vietnam, which might be a beneficiary of any movement away in terms of supply chains away from China to maybe try to get around tariffs. But that's kind of what's going on in the region, I would say.
All right, Heather, do we get any additional questions?
Well, we do have some additional questions regarding geopolitics. Do we have any thoughts about what has happened in South Korea with the martial law being passed and then subsequently removed very quickly within the day?
Yeah, so we talked about this last week. So this is really a budget battle. This is really a geopolitical issue. I know the president of South Korea had cited North Korean influence, and that this was the reason for martial law. It wasn't really. There was an election this year, and the opposition took control of the legislature, and they're completely opposed to the president on a number of the spending priorities, and they've held up the budget. And so the president wants to spend on some things, the legislature does not, or wants to spend on different things, and they've been at loggerheads over that. And so the president attempted to declare martial law in order to keep those legislators from being able to vote, and he'd be able to pass through his budget. Well, that failed spectacularly. And so now you're back to where you were, where they just can't seem to agree on a budget. And the two parties are at odds with each other. So this was a budget battle, just like it is in France. In France right now, we've got a government collapsing with a no confidence vote last week. But this really isn't political. I mean, it isn't geopolitical. It's really very political and really very much about a budget. This is a sign of things to come in 2025. Maybe we could have made this as a risk, a surprise on the list, but it wasn't really a surprise. Budgets are going to be very, very challenging. The U.S. faces a budget battle over a debt ceiling issue in the first half of 2025 as well. So you're going to hear budget battles and the political consequences of those. And you're going to hear both sides talking about how dramatic the consequences are and, maybe invoke geopolitical concerns. Not really geopolitical concerns. This is the same kind of battles that we've had here repeatedly in the US. We're going to have them again. They're having them in Europe. They're having them in Asia. Not uncommon. So not really geopolitical in the sense that, Syria, was geopolitical over this weekend. This was just more of a budget battle.
Regarding Syria, since you mentioned it, do we think that the toppling of the Assad regime is going to move the needle in either direction, peace or additional war?
Hard to say. It does give additional points of leverage against Russia. So Russia has military bases in Syria that are now at risk. They like to operate those bases because some of them are used to support their operations in Africa, supporting movements there. I don't know what else to call them. Awful things in Africa that Russia supports. But that's where they operate them from. They also have, I think their only Mediterranean port is in Syria as well. So they really like to keep that naval and air base. But that's going to be at the whim of who's ever in control of Syria. And maybe that will be determined with Turkey involved, and Turkey might be influenced by Europe and maybe the US. And so there's a lot of give or take here in terms of, Russia has certainly overcommitted itself in Ukraine, and now where do we go from there? So yes, I would say at the margin, this probably makes some movement towards a ceasefire agreement more likely, because this puts Russia a little bit on its back foot. But I don't know. I mean, geopolitics aren't really my strong suit. I'm not really a geopolitical strategist. Just trying to figure out what it means for the markets. And what I would say is this probably makes a disruption in oil production less likely because there now has been this new development where everyone wants to kind of see where the chips fall and see where things lay out, rather than trying to force some other change in the borders or calculus but based on attacking some oil infrastructure. So yeah, I mean, I guess long answer to basically say I don't know, but I think it does push more in the direction of a potential ceasefire agreement.
All right. Well, that seems to be all the questions that we have, though we do have a lot of our viewers wishing all of us a very happy holidays and a Merry Christmas. So I wanted to express that sentiment along to the rest of the team.
Thank you so much. Thanks everybody for watching the show, and we share your sentiments and right back at you. In fact, please check out my video on X. A lot of fun there with that little "Twas the Night Before Christmas" market outlook put to poetry. All right, thanks Heather, thanks Michelle, our producers Andrew and Gabe, and everyone for the questions and joining us each week. Happy holidays, and tune in each week at 11 a.m. Eastern. Although this was the last one this year, but next year tune in each week at 11 a.m. Eastern to catch the replay on YouTube. Also, be sure to click like on the show and share your comments on what you're watching in the markets. We'll see you next week. Or no, we won't. We'll see you next year.